touch base with Ramanathan K, who's the CIO of ING Investment Management India, joins us on the show live. Mr. Ramanathan, thanks very much for taking out the time. What do you make of what the market can do in the near term, given the volatility that we've been stuck in pretty much?
Actually, the key issue which is troubling the market today is GAR provisions and implementation and applicability. A lot has been already talked about in several channels regarding that. So we need more clarity, which is expected hopefully over the next few weeks. Because if clearly the FI, P-note holders, private equity, hedge fund, long only guys are being targeted, that's not going to bode well for the market. Today is a time when we need capital flows. We have a huge current account deficit. We have a huge fiscal deficit. So without capital flows, you would have significant pressure on the rupee, and that's going to be very negative for markets. So clearly the outcome of or clarification on the GAR provisions will drive the direction of the markets in the short term.
Ramanathan, what happened today with regards to PNGRB and the margins for IGL? I mean, it's not an isolated case of interference into how the earnings or the profits of a PSU would shape up like. You think that kind of sours the mood for investments, not just via the auction route or the IPO route or the IPO route, but investments, basic investments in general for the PSU basket as a whole?
Surely yes. The step taken by PNGRB has been very negative for the company, and we have seen a significant derating as well as expected EPS downgrades for the stock. Surely it is negative, and we have had several such cases of orders being implemented which significantly impacts profitability. We have seen the case of ONGC, we have seen the case of Coal India, where there is no clarity on implementation in terms of how much they have to provide for if they default on the 80% FSA. And we have seen the GAR provisions, which is supposed to be retroactively implemented. So all these surely do not give a positive connotation for global investors.
So Ramanathan, what do you as a fund manager do? I mean, without getting into specific names, but an IGL may have problems of its own and still undecided as to what the impact could be. But a Coal India, a large company like Coal India, wherein funds would probably need to allocate some funds by virtue of it being in the index as well. What does one do with a Coal India, with a BHEL, with a couple of these others, say a GAIL, for example, wherein the apple cart seems to have been upset by what's happened to IGL today? I mean, do cuts like these present an opportunity to buy? Or would you as a fund investor be very skeptical and wary about investing into these companies and therefore probably just avoid them and be happy with the positions that you have right now?
I can't talk, unfortunately, on specific stocks. Sure. But vis-a-vis the oil and gas sector, we are underweight in some of the names which you mentioned. Some of the names which you mentioned, we do not have at all. But I wouldn't like to paint all companies in the PSU space with a negative brush or a black paint. Surely these are stock-specific issues. From an overall perspective, regulatory changes are impacting stock performance as well as profitability negatively, and wherever the risks are perceived to be pretty high, we would surely look to go underweight. Okay,
what's the sense, Ramanathan, then on specific issues? Let's talk about well, something that will come up in a day or two from now, and that is the kick-starting of the earnings season, and IT in particular with Infosys. What's the belief? I mean, expectations are not as good as what they were at Q3, and the managements have been candid enough to say that Q4 might not be as great. But it will also be important because there will be commentary set up for FY13. What do you expect the delivery to be in Q4 and the commentary to be for FY13?
Yeah, one good thing about expectations vis-a-vis the IT results is that the expectations are poor. Managements like TCS as well as Infosys have already guided for poor volume growth. So we are going into the IT result season with poor expectations, which is actually positive. From an overall perspective, what we hear is the budgets for FY13 or CY12 in the case of global companies are at best flat, which in fact is pretty good. This bodes well for a 13 to 16% earnings growth for next year. And valuations in this space are, especially the large cap, is in the range of 15 to 17 times. So valuations are not expensive. If you have issues in terms of global flows because of GAR provisions, rupee should depreciate further if there is a sell-off. That should again be positive. So overall, we are positive on this phase and overweight the sector.
Right. What about the defenses and your approach out there? Because we've seen a score of upgrades coming in for pharmaceuticals. Technically also these stocks, as we just discussed, are showing some sort of resilience to the market as a whole. Even for that matter, FMCG. Are you scaling up your exposure there?
Not currently. The stance which we have adopted in the portfolios is a sector-neutral stance. And we are trying to add alpha through stock selection rather than huge sector bets. A couple of sectors where we are marginally overweight, I wouldn't say hugely overweight, are financials as well as IT. But clearly we are not looking to add alpha through huge sector calls and would focus more on stock calls within a sector rather than sector calls.
Do you like real estate by any chance? I mean, real estate or pseudo real estate, because there have been bunches wherein stocks like Century Textiles or a Bombay Dyeing and a Raymond, which form that pseudo real estate pack, have moved. And the dealing rooms seem to be suggesting that there is quite a bit of accumulation happening in select mid-cap real estate stocks as well. You buy that argument, you buy the story, or you avoid the pack completely?
We avoid the pack completely. It's, apart from some of the names which I mentioned, which are pseudo real estate, where possibly land parcel sale could result in one-time windfall profit, which is very difficult to time. Say, for example, Raymond, the talks have been on for the past 2 to 3 years, but still we have not heard anything concrete. So you will have these phases when some names like these will come up, and you could see maybe 10-20% upside movement in these prices. But that's not something which we would look to play at. In terms of other normal real estate companies, we are underweight the sector. Key issue which troubles us always has been corporate governance and what is shown in the results. So we are underweight that sector.
Indraprastha Gas, going off real estate, but Indraprastha Gas has sunk further now. So 228 or 227 is where that one is trading. So it's gone down further from those 235 kind of levels. So remember, Gujarat Gas is the other one, which has taken a deep knock, 16%. So after stabilizing around that 10% mark for Gujarat Gas, that one has taken it as well. A couple of others have gone down quite a lot. Gujarat State Petronet is down close to 9% in trade. So some of the weaker names have only gotten weaker. It's not looking too good for that pack. Some profit booking seen in stocks like IVRCL as well, down 5% after a brief uptick. The other pack, Ramanathan, that is weak today, or in fact weak over the last couple of days, is cement. And while there is a trading talk of some negative news coming in, the valuations aren't exactly poor. In fact, they're probably fairly rich right now in terms of their historical valuations, at least the last 3 or 4 years that we've seen. What do you do with cement now? Ahead of earnings, with the stocks having done what they have done, do you get out of it, or is there still a good enough investment opportunity?
We are underweight the cement sector, as you rightly said, especially in the large cap space. Valuations, if you consider EV per ton, are pretty steep. There has been a good amount of price increases, supply disruptions, cost pushing price increases which have happened, because of which possibly the results could be pretty good. Also, the volume growth has been in the 6 to 9% range. But the worry for us now would be the outcome of the investigation of Competition Commission of India, which is expected this month. So if there is a negative outcome in that report, surely considering the steep valuations, there could be sharp downfall in the cement company prices. So we are underweight this sector, more from valuation perspective as well as the risk of CCI's report.
A quick word really on how you would be approaching your portfolio in terms of the scaling up or scaling down you would be doing in respective sectors right now to protect your returns.
Yeah, as of now we are overweight, as I said earlier, financials as well as IT. We are neutral the consumer sector. We are underweight utilities. We are overweight consumer discretionary. And we are underweight metals. So that's our sector positioning as we stand today. We don't expect to make too much significant changes over the next few weeks. But we will continue to watch valuations in each sector. If there is huge swing in the market, if some sector becomes cheap for whatever reason it might be, maybe if the GAR provisions are the outcome of clarification from the Government of India on GAR turns out negative and possibly there could be a sell-off, then we would look to change the sector stance. But as of now, we don't foresee significant sector stance change going forward in the next few weeks. We would also revisit the overweight on financial sectors around the credit policy time. If in the run-up to the credit policy, you do have tendency of huge positions being built up in expectation of a rate cut. So if valuations become expensive, we would surely look to scale back our overweight in the financial sector.
Ramanathan, other things remaining constant, if indeed the GAR provisioning doesn't come out to be positive, it comes out negative for FIIs, how do you tactically change your portfolio positioning? Is it because of the movements that will happen in the resultant fallout, or it is based on the FI positions that certain sectors or certain large cap stocks hold?
See, as a policy, we don't take significant cash calls. We have a cash call cap of 10%. Surely, if the market falls, if the outcome of the GAR provision announcement is negative, the high beta names, which possibly could be metals, industrials, financials, could significantly fall. So, depending on the valuation and at that point in time after the fall, we would review our stance and possibly overweight some of these high beta names.